Hello, everyone. Welcome to JMac Investing. My name is Jason. We have another CEO interview today. We have Jared Kaplan, who is the CEO of OppFi, which is coming public via a SPAC merger, FGNA America Acquisition Corporation. Currently, the ticker symbol is FGNA. And so, no further ado, I'll go ahead and bring Jared on. How are you doing, sir?
Hey, nice to see you, Jason. Thanks for having me.
I really appreciate you coming on the show. How's your week going?
It is busy. I don't think anyone tells you what the reality of what happens when you announce a deal like this. And it's been awesome, but busy since that date. And we got a lot of great things happen with the business as well. So we're balancing a bunch of things, but all good problems.
Well, I mean, yeah, that's a good way to start things. I mean, I'd love to hear some of that. Well, what does that all entail? Okay, you build a business, and then all of a sudden you have this opportunity to come public, which this really wasn't available. Just I would say 10 years or so ago. I mean, the SPAC structure was, but the new SPAC boom, which has come and it's kind of slowed recently, but nonetheless, I love to hear some of the stories of the process behind the scenes.
For sure.
You got to get all these lawyers involved, right? I mean, it's
a lot of lawyers. I tell you, man, if I have to admit, like, I was not a SPAC expert a year ago. We came out of COVID with a business that was performing very, very well. I mean, COVID was the first dislocation economically that we have had to navigate. The business was founded in 2012, but most of the growth has been since 2015. And prior to COVID, I mean, we were rocking and rolling on all cylinders. So we were starting to think about public market options. COVID hits. My CFO did not have pandemic in the budget. Unbelievable. Like, I would think you would have the foresight to plan that. But pandemic hit. We dusted off the recession playbook. We went to work. It took about 90 to 120 days to recognize where we were. We felt we were in a really good position. And we picked our heads up again and we said, okay, let's look at a traditional IPO, or let's look at what had become a pretty interesting endeavor, which was all these SPACs were reaching out to us. I mean, as a financial technology company growing rapidly and profitable, which is highly unique in the fintech space, we were getting a lot of calls. And so after doing our research, we thought the SPAC route was really interesting, but we wanted to make sure it was with the right partner. And FG, their chairman's Joe Moglia, and also their key lieutenants, Kyle Sermonera and Larry Sweats. They're just like unbelievably smart public market guys. And Joe is legendary, right? He built Ameritrade and has had tremendous leadership success, not only in business, but in the football world. And his acumen, credibility, coupled with Larry and Kyle, we were like, this is a terrific partnership. And, SPAC route's a little bit more expeditious. You get the opportunity to go on the road with some detailed investor presentation information to tell the story. And that's what we needed to do because we never raised any outside money to build this thing. The Schwartz family, who seeded the business, founded the business, they put about $12.5 million in, and then they hired me as CEO in November 2015. And since then, it's all been debt capital and cash flow from operations to build it. And that means we're relatively unknown in the investor community. People haven't heard of us because we didn't raise hundreds of millions of dollars of venture capital. And the Schwartz Capital family, like, they're so storied in Chicago, but they don't have the brand name of some of the blue chip venture capital firms as well. So with Joe being able to speak on our behalf, and that gives us instant credibility. And that's what I've been spending my time on since mid-February, is meeting with institutional investors and telling them the story, introducing them to the company, and building rapport as we go out and build what we think is a decade-long vision to create the digital financial services destination for the everyday consumer.
Very good, very good. Okay, so let's back up a little bit. Let's kind of, for anyone who's unfamiliar with a little bit of the backdrop story of your company, which is it was Opp Loans, and now after merger it's going to be OppFi, right?
Right.
Is that correct?
That's right. That's right.
Okay. So yeah, give us a little bit of the backdrop. How long have you been in business? Tell us a little bit of the storyline behind your company. Opp Loans, which is becoming OppFi.
Sure. So the patriarch of the Schwartz family, Ted Schwartz, had built a very successful business in Chicago called APAC Customer Services. He took it public in the mid-90s and sold it to JP Morgan's private equity group in 2011. That seeded the family office. And his son, Todd Schwartz founded this business, stood it up in 2012. He had seen after the Great Recession, all this capital had evaporated from the middle income consumer. And the markets of last resort were really crummy if you needed credit access. And he said, we can build a better platform that's fair, that can help people in difficult situations, and then ultimately rebuild their financial health. And so that was what they started to do 2012 to 2015. They installed the credit philosophy. Yep, go on. Sorry.
I was just going to interject. So the crummy, like payday loans, that's what you're referring to?
Payday loans, auto title loans, using bank overdraft, tribal lending platforms, the unregulated market. Yeah, all the above.
Okay.
Yeah.
Yep.
So Todd was really smart. He installed his dad's customer service philosophy. APAC was known for outstanding customer service, and he hired probably the smartest guy in non-prime credit, an ex-Cap One HSBC guy named Chris McKay, and they installed the credit philosophy. Chris is still with us today. And that's what I inherited. They had figured out the credit, figured out the customer service, and they said, okay, go and scale this thing for us, but whatever you do, don't screw up the customer service or the credit. So I was like, okay, got it. The opportunity is massive, right? There's 150 million consumers in the country that have less than $1,000 of savings in their bank account, which I didn't recognize. And if you have less than a 620 FICO score, you're essentially abandoned by the mainstream world. And like we talked about, those products of last resort, they're not great. So Op Loans is the initial product that we launched with. And that is a credit access product that is originated by banks. And we power the banks to do so based upon our financial technology platform. And it's structured in a way to rebuild financial health. And from there, we're extending to products that we can use to graduate customers back to the mainstream, and then longer term, fill out that financial services suite with opportunities like mobile banking and ultimately mortgages and investing to build the OppFi brand. And that's why we've pivoted on the branding, because Op Loans describes that historical product, but it's one piece of a huge vision to build what we hope is the place to be for this consumer.
Right. So, and I guess built into the loan platform, there is an AI component to that. Is that correct?
Yeah, it's all powered by the technology that we have. That is a big part of that is the decisioning tool. And at this point, we've facilitated over 1.6 billion loans. There's over 14 million repayment events that we have been able to track. And that all aggregates to about 7 billion data points, which goes into our fancy technology. If you're a fintech company these days and you don't say AI, machine learning, crypto, and blockchain, what are you, right? But the reality is it's that good. The AI and that machine learning that we've employed has allowed us to get better and better, and the banks ultimately adopt that as part of their credit models. And there's a long way we can go. I mean, there's so much better that we can do for the consumers as we get larger and the data sets gets bigger and better. But we're really proud of what we've done thus far. And you should ignore everything I say. Like, don't believe a word. And I always tell people, go see what the customers say, because that's how you know if you've got a great business. If the customer is talking about the value you create for them, that's gold. And on the Better Business Bureau and Google, Lending Tree, all over the place, they're saying great things about us every day. And that's what you should take a look at.
Right. Now, you were saying so non-prime is your target customer, meaning like 625 credit score below. And you were saying that they've been kind of forgotten. Is that because of the real estate crash? They kind of fall off the map then, or?
So I think there's two separate themes there. So credit score has always been viewed as your test of credit worthiness. And it's just not a great predictor, especially as you move down the FICO spectrum. And so we believe, like, we don't use anything from a traditional perspective to understand creditworthiness. We use all this cool alternative data to figure out your ability and your willingness to repay. Now, one of those levers is ensuring that you make enough money and that the consistency of income is such that you can repay the loan. And that's completely antithetical to what happened during the mortgage crisis, which was essentially lending people money that didn't have income to repay it. So although it's focused on a consumer that is not all that much different, the underwriting methodology behind it is completely different. And you can see that in the credit performance over time.
Okay, that makes sense. So it looks like you guys, you work with smaller banks and you outsource services like marketing, underwriting, decisioning, and customer service. And you were alluding to some of the other, you've been mostly loans, but you're alluding to some of the expansion plans in the future. Let's talk about that a little bit. What do you guys envision for a master plan for OppFi as it becomes public?
Yeah. So we started off as an 18 state licensed lender and had 18 different products in 18 different states. And then we started to get some inbounds from some regional and community banks who recognized how underserved this marketplace is. And they were struggling to compete with the large bulge bracket banks. And they said, hey, you've got a really interesting platform. We're a bank. We can lend nationally based upon where we're based. So can we figure out some kind of partnership here? And that partnership's not very unique in fintech. You've got lots of great companies out there that have partnered with banks in similar matters, the Affirms of the world, the Upstarts of the world. But essentially, the bank provides all the regulatory and compliance oversight. They essentially can approve all parts of the process. They ultimately set up the credit model based upon our suggestions from an alternative data perspective. But then they hire us to do all the acquisition, all the underwriting, and all the servicing. And that historically has been focused on this OppLoans product, but now we are quickly expanding elsewhere. We launched an installment loan called Salary Tap here recently. That is an installment loan that's repaid by payroll deduction. Payroll deduction is highly secured form of repayment. And so those products can be offered by the banks at much lower rates because the losses are lower. We're going to launch the OppFi credit card here in the early second half of the year. That's a perfect graduation product for this customer who has proved themselves in the higher cost installment loan. Today, when you apply, we go out to near prime lending platforms, about 20 of them, and we see if any of them have an appetite for the product before they're placed in the higher cost products. There's no reason why we have to give that business away long term. Now, only 10% of the time do those near prime lenders offer even one product to the consumers today, and they close it only 1% of the time. But we know with our data, we can go upstream into the near prime segment. And then longer term, we'd love to wrap around mobile banking. We're looking at point of sale. And then more aspirationally, if we can allow access and then graduate you to mainstream credit, the next thing we want to do is help you build savings and ultimately build wealth through owning a home or through investing. So there's a lot to get done there. We got a bunch on our plate this year, but we have tremendous ambition, and we don't want to do it just in this country. Long term, it's a global opportunity. So lots and lots of work for us to do.
Okay, yeah. So you touched a little bit on installment loans and that whole end, of the product that you'll be developing in the future. It seems like I read somewhere that you guys were hoping to, was it potentially partnering, because you did name drop Affirm, and there's also Catapult.
Sure.
Would you be looking to partner with some of those guys, or would you be competing with those?
We could potentially partner, or we could potentially compete with them. I mean, if you think about the product, that OppLoans product, historically, it focuses on a very similar customer to what Catapult focuses on, but the mechanism in reaching the customer is different, right? Catapult's doing it through the point of sale, through a lease-to-own product. Our customers will get the cash in their bank account today, and then they can use it wherever they need to use it. Typically, it's car repair or unexpected medical, but they can also buy durable goods with that cash. And that lease-to-own product is exclusively tied to durable goods. So the worlds are pretty close together as it is today. It's just that delivery model, and we certainly are going to look at that space going forward. It's gained a lot of traction here through the pandemic, and I think it is here to stay as a theme for the long term.
I was also reading that you guys were having a desire to enter in the mobile banking space. What does that entail? How difficult is that to enter into?
Yeah, what people don't realize, for our customers, half of the customers that we see today bank at the largest banks. They just don't have any credit access from them. So we view mobile banking as a really nice adjacent opportunity for customers to do even more business with us. They're so grateful and loyal when we say yes, right? Imagine a customer's experience. Their car broke down. They need to fix it tomorrow. They walk into their bank laughs at them. They go online, they're declined by anyone. Our banks say yes. Now they're unbelievably grateful. And so can we cross-sell and offer more products to them? And why we like mobile banking is that if you have the direct deposit for the customer, you're first in line to get repaid. So that means that repayment's more highly secured. If you offer a debit card, you're able to aggregate some more debit card transaction data that will also help with the underwriting algorithms. And so it's all about creating that stickiness and data feedback loop to continue to improve the products so that they are cheaper and better for the customer. And that's how you build real sustainable competitive advantage over time. So that's definitely on the roadmap, and we could build, buy, or partner for that. and that analysis is just getting underway here, and likely a 2022 initiative.
Yeah, I guess we have a recent sort of example where Sofi is coming public via SPAC, and they have acquired a community bank or something to kind of I don't know if it's circumvent, but it's to expedite some of the legal things that will come about to open up their opportunities to what they can offer their customers, right?
Yeah, I think the way they look at it, right, it creates a bit more of a streamlined approach. They can reduce their borrowing costs. They're able to park deposits directly. You can do it as a non-bank as well, like Chime is doing, right, with third-party banks, and just provide the front end. I think we have a lot of respect for SoFi and what they've built for the Henrys, the high earners, not yet rich yet population. I mean, they've got a lot of products stood up, and that vision is really cool. And their CEO is amazing, right? And I think we have a similar vision for this everyday consumer. This person who's making 50 grand, has a job, has a bank account, but has basically been orphaned. Now, my CFO has not, I always joke, has not let me put our name on Wrigley Field yet, right? Like SoFi did on that beautiful Rams stadium. But we've been pretty successful building the brand quantitatively with the customers in a more guerrilla manner, and that's why we think as we're able to string up new products here, they're going to be incredibly accepting of them.
Let's talk a little bit about your valuation, your past growth, and your future projections, which is one of the things that's kind of coming under the microscope, is that SPACs can, or companies coming public via SPAC can put out future projections, which I think most people prefer, especially even with IPOs. You know, it's for an investor. I'd like to see what a company thinks they could do. So whatever. So I think it's a good thing. So, but I was looking over even your past. It looks like you have had some incredible growth over the years.
Yeah, we've had a great couple of years here, 5 or so since I've been CEO, and before that, the company was very successful. We think the valuation is incredibly attractive where it is right now. We cut the deal in December. The market's run up quite a bit since then. The Schwartz family are stand-up people. They shook hands on a deal. I also think there's some interesting dynamics of this transaction, given the fact that the company wasn't very well known by the institutional investor base. We didn't do a PIPE. We didn't do the cash. So there's no PIPE. The selling shareholders taking a little money out as part of the transaction, although all the selling shareholders, which are basically the Schwartz capital family and management, still will own 60+% post the deal closing. We wanted a fair valuation where people get involved now and everyone can make a bunch of money in the future. So that's what we plan to do. And I think from a projection perspective, the SPAC we always say all SPACs are not created equal, and certainly all SPAC targets aren't created equal. There's very few SPAC targets that are profitable, let alone with the track record of growth that we have. So we think that's pretty unique. We built our reputation with debt providers by hitting every number we ever gave them. And we made massive improvements in our cost of capital and financing structures over time because of that. And we hope to do the same thing on the equity capital markets, is being thoughtful about how we guide to the numbers and hit those numbers and earn all the credibility and the confidence that you need to be a successful public company.
Very good. Very good. Yeah, it makes sense. So from what I was also reading and researching about your company, it looks like, I guess, someone to kind of compare you against for someone looking to see the potential. Upstart, which is a publicly traded company, is someone who you kind of align up with right now with your current business model. So how would you say you all stack up against them, which right now I think the market cap is $7.2 billion. So for an investor, if you guys could grow into that would be a nice a nice multiple.
Totally. Upstart's an amazing company. They've done a great job. The delivery model is incredibly similar. We actually share a bank partner on the front end, whereby the bank's originating and they are leveraging outstanding AI and machine learning technology to ensure creditworthiness of the borrowers. And we're both buying back the receivables from the banks. And then the one difference is that we have historically kept those receivables in-house to earn the full unit economics on them, where they have sold those to third parties. And also it's a different customer. They're going after high 600s, low 700s FICO customer, where we're focused on the 550 to 600 FICO customer segment. So those are some of the differences, but certainly we respect their public market debut and hope we can work some of that magic. I think, being realistic, there's also some regulatory risk with our business that we're incredibly thoughtful about. That's why we're diversifying the product suite. That's why we're really excited about salary tap and credit cards. We're also looking to go up market a little bit. And we spent a tremendous amount of time working with regulators and members of Congress to educate them on the dearth of credit access in this country, why the products on our platform are structured in a way that should rebuild financial health. And we hope to quantifiably show how we improve the financial health of our customers over time, either through increases in savings or increases in credit score, graduation to mainstream products. So there's a lot going on there. And we're going to get out here as a moment of time in the de-SPAC process once we close this transaction, hopefully at the end of the second quarter. Then we're going to put our heads down. We're going to build off this vision. And I am very confident the public markets will reward us for doing so.
Yeah, well, yeah, really, really excited to see and follow along the journey here. It's been great. I don't have a ton of insight into the industry or the market. I've been very, very heavily focused in EVs and a lot of that type of technology. But yeah, so I want to give you the last word here, and we'll close it out. And anything that I missed that you wanted to cover, and let the audience know about OppFi otherwise.
Yeah, I think the biggest thing, especially when I'm talking to the investor community, lots of investors have never used these products, right? And when they approached me to be the CEO of this company, I was not well educated on the realities here, that there are so many people without savings, and without products like these, you literally have no access. And when you're faced with a difficult situation, you need credit to go fix your car, to go pay a doctor. And that's where we're able, through the power of these banks, provide access. And that's part of the story, right? Provide access and best available product at a time of need. And the fact that we go to those other near prime companies first proves that without platforms like this, these customers would be very, very difficult shape. Now, when we get public, we want to use those earnings calls to what I said earlier, is not just show terrific financial performance, but also prove the ability to help the financial health of our customers. And I know the space is going to change dramatically over the time here. You see some of these blue chip companies like Square through Cash App piloting small dollar loans. You've got companies like Chime trying to figure out lending for a similar customer base. So although we've got less competition today than we did 5 years ago, I think the next 5 years should be quite interesting. And it's certainly something that investors should be taking a look at, who's going to be the winner. And I think we've got as good of a chance as anyone.
Sounds good. Sounds good, Jared. Well, you've been very generous coming on. Really appreciate the time that you've given, and wishing you all the best as you de-SPAC.
Thank you very much. Appreciate the opportunity.
Thank you so much, sir. Have a good one.
You too.